Here's a number that should stop you cold. In 2025, China posted the largest trade surplus in the history of any nation on Earth. $1.2 trillion. That's not a quarterly figure. That's annual. And it's bigger than the entire GDP of Saudi Arabia. The headlines celebrated it as proof that China was winning, that Trump's tariffs had failed, that Beijing was untouchable, that the world simply could not stop buying Chinese goods. And on the surface, they were right. China is the largest exporter in nearly 60% of all product categories globally. It controls more than 20% of all industrial goods flowing through the world's trading system, up from just 5% in 2001. In the first quarter of 2025, nearly 40% of China's GDP growth came entirely from net exports, the highest share in over a decade. So why, with numbers like that, are Chinese households getting poorer? Why are factories cutting prices so aggressively that producer prices have now fallen for over 3 consecutive years? Why is youth unemployment sitting at nearly 17%? And why is the IMF, not some think tank, the International Monetary Fund itself, warning that China is simply too large to survive on exports alone? Here's the dirty little secret. That record trade surplus? It's not a sign of strength. It's a distress signal. Because the same machine that built the world's second largest economy is now eating it from the inside. So here's exactly what we're going to unpack today. 1. How did China build an export machine so dominant that the rest of the world genuinely couldn't compete? 2. What's actually happening inside the Chinese economy right now, because the domestic picture looks nothing like the export headlines? 3. Why are Western tariffs and global trade wars not just a short-term headache, but a structural threat to the entire model? And 4. What does the endgame actually look like? Because Beijing knows this model is broken. The question is whether they can fix it before it breaks them. Part 1. How China built the machine. Let's go back to basics, because context matters here. For roughly 3 decades, China's economic strategy was brutally simple and extraordinarily effective. Suppress domestic consumption. Keep wages low relative to productivity. Flood global markets with cheap manufactured goods. Reinvest the profits into more industrial capacity. Repeat. It worked beyond anyone's expectations. China went from accounting for about 1% of world trade in 1980 to becoming the single largest goods exporter on the planet. By 2025, China's GDP had crossed the $20 trillion threshold. But here's what that strategy actually required. Chinese households had to give up. They consumed less so factories could produce more. The social contract was essentially, you'll be employed, but your wages won't rise fast enough for you to actually buy what you make. The goods are for export. That's not an accident, it's the design. Household consumption in China today sits at just 40% of GDP. That figure has not meaningfully moved since 2005. In the United States, the comparable figure is 68%. Even Germany, which the world considers a hyper-efficient export machine, sits at 50%. China is an extreme outlier. And that gap is the core of the problem. Part 2. The domestic picture is a disaster. Think of it this way. Imagine a factory town where the workers build furniture all day but can't afford to furnish their own homes. So all the furniture ships out. Great for the trade balance. Terrible for the town. That's China right now. And it's getting worse. The property market, which once represented close to 80% of Chinese household assets, has been in freefall since 2021. Home prices have already fallen between 20 and 40% from their peak, depending on the city. A Reuters poll projects prices will fall a further 2.8% in 2026 alone, with only modest stabilization expected by 2027. Urban household net worth fell from roughly $163,000 to $130,000 in just 2 years. That is not a statistical footnote. That is a direct hit to consumer confidence and spending power. And households have responded exactly as you would expect. In a People's Bank of China quarterly survey, a record 64% of Chinese households said they preferred saving money over spending or investing. Over 60% have held that position consistently since late 2023. When people are watching their primary asset, their home, lose value every quarter, they don't go out to dinner. They don't buy cars. They hold cash and wait. The consequence? Retail sales in 2025 grew at just 3.8%, while industrial output grew at 5.9%. The economy is producing far more than it is consuming domestically. Consumer inflation for the full year of 2025 was at its lowest level in 16 years. Producer prices, what factories charge for goods, fell 2.6% for the full year in 2025, the third consecutive annual decline. Factories are in a brutal race to the bottom. Chinese economists have a term for this: involution. It means competing harder and harder for a shrinking slice of a stagnant market, cutting prices, sacrificing margins, burning through capacity just to survive. When domestic demand isn't there, companies don't sit idle. They dump those products abroad, at whatever price the market will bear. Which is how you get a $1.2 trillion trade surplus alongside a deflationary spiral at home. Youth unemployment tells you the rest of the story. As of early 2026, 16.9% of young people aged 16 to 24, excluding students, are unemployed. The National Bureau of Statistics puts it at 17.3% as of October 2025. In the world's second largest economy. That is over 3 times the national urban unemployment average. And there's a darker subfigure: this generation of Chinese graduates entered a labor market that no longer has the high-skill service sector jobs to absorb them. The property developers went bankrupt. The tech platforms got regulated. The tutoring companies got banned. The jobs didn't come back. Part 3, the tariff trap. Now here's the twist that most commentators are missing. On the surface, China shrugged off Trump's tariffs. The trade surplus went up, not down. Exports were simply rerouted through Southeast Asia, through Latin America, through Africa, through the EU. Beijing and its defenders pointed to this as evidence that the model was resilient. But look at what actually happened. China's export resilience was not a sign of economic strength. It was a sign of desperation. Oxford Economics notes that China has experienced far more aggressive export price deflation than domestic deflation between 2023 and 2025, meaning China was slashing the prices of its exports even more steeply than domestic prices. That is not dominance. That is a fire sale. And the world is starting to notice. The EU is now watching its own trade surplus shrink as rising Chinese imports crowd out domestic production. Anti-dumping investigations are multiplying. The same rerouting strategy that helped China dodge US tariffs is now generating friction with ASEAN partners, with India, with Brazil. IMF Managing Director Kristalina Georgieva put it plainly: China is simply too large to rely on exports for growth, and continued dependence on export-led growth risks escalating global trade tensions. Here is the structural trap. To fix domestic demand, Beijing needs households to spend. To get households to spend, it needs to restore confidence in the property market, build out a genuine social safety net, healthcare, pensions, unemployment insurance, and raise wages meaningfully. That takes years. Possibly a decade. And in the meantime, the export machine has to keep running. Except the doors it's been knocking on are increasingly slamming shut. The World Bank and the IMF both note that China's consumption share of GDP, at 39%, remains well below the roughly 60% typical of developed economies. Beijing's own Politburo identified boosting domestic demand as its single top economic priority for 2026. That's not ambition. That's acknowledgement of failure. Part 4, the twist. Here is the counterintuitive reality that nobody in the financial press wants to say clearly. China's record trade surplus is actually a symptom of a broken domestic economy, not proof of a thriving one. The more China exports, the more it reveals that its own people cannot afford, or are too scared, to buy what they produce. China's economy grew 5% in 2025 on paper. But investment fell 3.8%, the first negative print ever recorded. Net exports accounted for 32.7% of that growth, the highest share since 1997. Strip out the trade surplus and China's underlying domestic growth story looks far less convincing. The headline number is increasingly a function of how aggressively factories can dump goods on international markets. The political challenge for Xi Jinping is this. The export model was the social contract. It provided employment, it drove GDP, it justified one-party governance through economic performance. If the trade doors close, through escalating tariffs, through anti-dumping duties, through trade blocks explicitly designed to exclude Chinese goods, the social contract collapses. There is no domestic consumption engine ready to replace it. It would take a fundamental redistribution of income toward Chinese households, something that structurally threatens the political economy that the party has built. And Beijing knows this. The 15th Five-Year Plan, due in 2026, is explicitly oriented around consumption-led growth. Scenic trains, cruise tourism, concert subsidies, Beijing is trying everything. But retail sales growth of 3.8% when the economy needs 6 to 7% consumer-led growth is not a turnaround. It's a holding pattern. The IMF forecasts China's growth will slow as the model hits its limits. Tariff escalation scenarios modeled by the fund show global GDP could take a hit of over 0.6 percentage points by 2028 in a full trade war scenario, with China bearing a disproportionate share of that damage. This is the exact reason the next video on this channel matters. We're going to look at which countries are positioned to absorb the manufacturing that leaves China and whether Southeast Asia is actually ready to take the baton, or whether that story is more complicated than the headlines suggest. Hit subscribe so you don't miss that one, and if you want the weekly breakdown delivered to your inbox, the free newsletter link is below. Thanks for watching, mate. Bye.